Let us start with chapter recording of transactions, second part. Now students, we had done earlier that transactions are recorded in journal and ledger. Let us understand some other books in which transactions can be recorded. Now first of these books is cash book. As the name suggests, cash book. What is a cash book? Cash book is a is a book in which transactions of cash receipts and payments are recorded. Now, it is a book which is maintained on cash basis, in which only those transactions in which we are either receiving cash or we are paying cash are recorded. It is a book of original entry. It is a book of original entry. And it serves the purpose of both ledger and journal. That means the transactions which are entered in the cash book are not recorded in journal. They are directly posted to cash book, and since they are posted to cash book, there is no requirement of maintaining cash account. Now students, cash book is of various types. It can be a single column cash book. Single column cash book. As the name suggests, single column. That means in this kind of cash book, only one account, that is cash account, is shown. Only the transactions relating to cash account are recorded. The second type of cash book is double entry cash book. Double column cash book. Now, as the name suggests, double column cash book. So, in this kind of cash book, two accounts, that is cash and bank, are maintained. Now students, in modern day business, cash and bank are used synonymously. I mean, you can make payments through check, they are counted as if they are made through cash only. Nobody minds being paid in cash or by paid in check. So this kind of cash book maintains two types of accounts, that is the cash account and the bank account. And the third type of cash book is petty cash book. Now students, as the name suggests, petty cash book. This is a cash book which is used to maintain the expenses of small nature, record expenses of small nature, petty nature, expenses which are not important enough to be recorded in either double column or single column cash book. Something like expenses of 5 rupee, 10 rupee, 7 rupees, 8 rupees. It is useless for a head cashier to waste his time recording these kind of transactions. So for this purpose, a petty cashier is appointed who maintains such record in the petty cash book. So now there are three types of cash books that we will study in practical also. One is single column cash book, in which only the transactions related to cash are recorded. Then we have double column cash book, in which transactions related to cash and bank are recorded. And lastly, we have petty cash book, in which transactions of small nature, of petty nature, are recorded. Starting with single column cash book. Now students, here is the format of single column cash book. Again, the format is almost similar to a ledger. In a ledger, there are two sides. One is the left hand side is the debit side and the right hand side is the credit side. But here only one additional feature is there, that debit side receipts is mentioned at the top, and on the credit side the payments is mentioned on the top. Rest everything is same, date column, particulars, ledger folio and amount. Then we have date, particulars, ledger folio and amount. Now students, let us make a cash book for these four transactions mentioned here. Now the first transaction that we have is on 1st January 1995, balance in hand. Now students, what does this imply? It implies that we have a cash balance of rupees 1 lakh in our hand from the previous accounting period. So now cash is an asset. Like all assets, cash has debit balance. So it is debit balance. So now on 1st January 95, to balance brought down 1 lakh. Since it is debit balance, so it is put on the debit side. Now the second transaction is on 2nd January 1995, that is paid to Ramlal. In this case, cash has been paid. Since cash has been paid or the payment has been made, it will be appearing on the payment side, and the payment side is the credit side. So on 2nd January 95, by Ramlal, amount is rupees 25,000. Again students, since in this case the payment was made, the entry has been made on the credit side. Now coming to the third transaction, that is cash sales. Now by cash sales we mean goods sold for cash. Since the goods are being sold for cash, it clearly implies that we will be receiving cash. Now we are receiving cash, so the entry would be made on the receipt side, and the receipt side is the debit side. So it will be to sales account, and the amount would be 50,000. Do not forget to mention the date here, which is 5th of January. Now students, coming to the last transaction that we have, paid wages. Again students, it is paid wages. Payment is made in cash. Now since we are paying something, the entry will appear on the payment side. So here the entry would be on date of 6th January 1995, by wages, 10,000 rupees. Now students, you must remember that the postings that we have done in a cash book are just like that we do in ledger accounts. The only difference that we have here and that is visible from this cash book is that only one part, that is the one relating to cash, has been recorded. The other part of the transaction would be recorded in the respective accounts of Ramlal, wages and sales, which is not shown in the cash book. Obviously they will have their respective accounts which are shown on different parts of the accounting books. So in cash book, only the transactions which involve inflow or outflow of cash are recorded. Now assume that there is a transaction, something like purchase goods from Ramlal. Now I'll add a new transaction, purchased from Ramlal. Purchased from Ramlal, goods worth rupees 20,000. Now students, in this transaction, there is no inflow or outflow of cash. It clearly is visible that goods have been purchased on credit. Since goods have been purchased on credit, there is no inflow or outflow of cash, so this transaction would not be recorded in the cash book. So now, once we have made all the transactions, let us total it out and find the balance. Remember, the balancing of cash book is done just like ledger. So let us total the debit side. The total comes to 1,50,000, and on this side the total is 35,000. So 1,50,000 minus 35, we have balance carried down as 1,15,000, and the total is 1,50,000 on both the sides. On last date, the date would be last date of the month or the week for which this cash book has been prepared. And in the beginning of the next accounting year, you must show this as a brought down balance. To balance brought down 1,15,000. Coming to double column cash book. Now students, we know that double column cash book shows both cash account as well as bank account. Cash account and bank account. Now this is how the format of a double column cash book appears. Again, debit side is the receipt side, credit side is the payment side. The only difference is that the amount column has two columns now, the one which represents cash and the second one which represents bank. Cash and bank on both the sides, debit and credit. Now students, it is amply clear that the entries in which cash is received will appear on the debit side of the cash column, and in which cash is paid will appear on the payment side of the cash column. But in cases where checks are received, now I am saying checks are received, so such entries are made in bank column. Whereas where checks are paid, the entries would be made in the bank column on the payment side, which is the credit side. Now students, it is very clear that only the receipts and payments of cash and checks are recorded. Now in this double column cash book, there are two special entries. They are referred to as contra entries. Now what is special about them? Usually all the entries are recorded on one side, either on the receipt side or on the payment side. But in case of contra entries, the entry or the posting is made on both the sides. That is, once in cash column and the other time in the bank column. Now these are the transactions in which both the accounts that are involved are cash and bank. Now let us illustrate. There are two types of entries. One is deposited cash into bank. Rupees 25,000. Now students, deposited cash into bank. Let us generalize this transactions. Now since we are depositing cash into bank, bank is the receiver. The journal entry would be bank account debited to cash account. The amount would be 25,000. Now students, bank account and cash account, these two accounts are involved, and for both these accounts the postings have to be made in the double column cash book. So it will appear on the debit side of the bank account and will appear on the credit side of the cash account. That is, on the debit side, that is receipt side, the entry would be made in the bank column, whereas for this, that is the cash which has been credited, entry would be made on the payment side in cash column. Okay students, now the second transaction is withdrew from bank for office use, rupees 10,000. Now here the owner or the manager or any worker has withdrawn 10,000 rupees from the business or from the bank account of the business for official use. So the journal entry in this case would be cash account debited to bank account. Since we are receiving cash, real account, debit what comes in. Amount would be 10,000. Now students, whenever we post this into our cash book, since cash has been debited, it will be recorded on the debit side, that is the receipt side, whereas it will be recorded on the credit side in the bank column. Now students, let us try and understand these two transactions by posting them here. For first transaction students, bank is debited, so on the debit side we will write to cash in the bank column 25,000, and cash has been credited, so by bank in the cash column we will make an entry of 25,000 rupees. Now both the postings have been made here. In ledger folio column we will write C against these two entries, so as to signify that they are postings from a contra entry. Similarly, for the next transaction, that is cash to bank. Since we are receiving cash on the debit side to bank account, contra entry, in the cash column 10,000, and buy cash, contra entry again, in the bank column 10,000. So students, contra entries are the entries in which, unlike other transactions where only one posting is made in the cash book, in these entries two postings are made, and they are peculiarly of two types, that is deposited cash into bank and withdrew bank from for office use. Let us prepare a double column cash book from the following transactions. Now students, just to recall, in double column cash book we have two accounts. One is cash and the second is bank. That is, a double column cash book shows the details of both cash and bank. And while attempting this, we must make sure that we are aware what is or what are contra entries. Now students, on 1st May 2006, cash balance. Cash is an asset, so it would be debit balance. And in case of bank, if nothing is mentioned, it is assumed to be a debit balance. Now, on the debit side, it would be written as to balance brought down. In cash column, 50,000 rupees, and in bank column, 25,000 rupees. Now students, for the second entry, that is the entry on the 7th May 2006, it would be goods sold for cash 35,000. Now when we are selling goods for cash, that means we are receiving cash. Since we are receiving cash, entry would be made on the receipt side. So on 7/5, entry would be to sales. In the cash column, because we are receiving cash, amount is 35,000 rupees. Now students, entry on the 8th May, it is paid to Anand by check. Now what is important here is payment has been made by check, and by check we understand that we are making payment through our bank account. So this would be recorded on the payment side but in the bank column. So on 8th May, the entry would be by Anand, and in the bank column rupees 15,000. Now students, second last entry is 15th May, received a check from Neeraj rupees 30,000 and deposited into bank. That is, Neeraj has paid us a check worth rupees 30,000 and we have deposited that check into our bank account. That means we are receiving payment from Neeraj. Since we are receiving payment, the entry would be made on the receipt side but in the bank column because the check has been deposited into bank. So on 8th May, it would be to Neeraj. Amount is 30,000 rupees and it will appear in the bank column. Coming to the last entry, that is on 25th of May, withdrew from bank for office use. Now students, it sounds familiar. We had done this in previous class that this entry is a contra entry. It is a contra entry. That means the postings will be made on both the sides, debit and credit. So let us identify the accounts, which account to be debited and which one to be credited. So withdrew from bank, that means we are receiving cash. Since we are receiving cash, entry will be made on the receipt side in the cash column as rupees 20,000. And since the bank is making the payment, to buy cash in the bank column, on the payment side 20,000 rupees would be shown as withdrawal. Again students, remember in ledger folio column we have to write C, which shows that it is a contra entry. Do mention the date here, 25th of May. Now since all the postings have been made, now let us try and balance this out. On the debit side, the cash has a total of 55 plus 50, that is 1,05,000. And the bank column has a total of 30 plus 25, 55,000. Now students, to get the balance of cash, remember we will deduct the credit side total from the debit side total of cash column only. There is no entry on the credit side of the cash column. That means whole 1,05,000 rupees is the balance in hand. The total is same. Similarly, to calculate balance in the bank column, we'll deduct the debit columns and the credit columns of bank only. That is 55,000 minus 35,000. So the total comes to 20,000. And the grand total of this column is 55,000. Now again, since no date is there, we'll assume that this is for month of May only. So for the month of May, the last date is 31st May. Then in the beginning would be 1st July 2005, and it would be to balance brought down 1,05,000 and 20,000. Let us make a cash book for the following transactions. Now students, on 1st March 2007, we have a cash balance of rupees 2 lakh. Cash is an asset, so this would be a debit balance. Now here, the bank balance has been shown as credit balance. So now students, remember, credit balance means overdraft. It is an overdraft. So this balance would be shown on the credit side. So let us post this. On 1st March 2007, to balance brought down 2 lakh, and the bank balance will appear on the credit side. Since it has been mentioned here credit, and credit means it is an overdraft balance. So on 1st March, it would be by balance brought down 10,000 rupees in the bank column. Second entry. Second transaction is on 5th of March. It says goods sold for cash rupees 1 lakh. Now since the goods have been sold, that means we are receiving cash for rupees 1 lakh. So since we are receiving cash, entry on the receipt side in the cash column. We are receiving cash. So 5th March entry would be to sales, and we are receiving rupees 1 lakh. Coming to the third transaction is on 7th March 2007. It is deposited into bank. Now, since we are depositing cash into bank, this is a contra entry. Again, contra entry appears on both the sides of the cash book. Now, deposited into bank means to cash. Since we are depositing into bank, bank is receiving. So, in the bank column on the receipt side, we'll make an entry of 50,000, and it would be a contra entry. So mention C here. Now the second posting for this contra entry would be, since we are paying cash, it would be by bank. So since it is a contra entry, two postings have been made, one on the debit side and one on the credit side. On 8th of March, the transaction is paid to Nikhil. Since we are making a payment, we will be making payment in cash, and payments are recorded on the credit side. So on 8th of March, it would be by Nikhil 20,000 rupees on the credit side in the cash column, since the payment has been made by cash. Coming to the last transaction, students, 21st March, it is received from Ajay. Since we are receiving from Ajay, so on the receipt side to Ajay, and nothing is mentioned, so we will be receiving cash. So in the cash column, 20,000 rupees on the receipt side. Again, let us try and find the balances. Total the cash account on the debit side. It is 2 lakh plus 1 lakh, 3 lakh 20,000. It is 3 lakh 20,000. Subtract the entries on the credit side, that is 70,000. So now the balance would be 320 minus 70, 2 lakh 50,000. Now students, the same thing would be repeated for the bank column. On the receipt side, the bank column shows a balance of rupees 50,000. This is the totals. Now, from this total, deduct the total on the credit side. 50 minus 10, so the balance would be 40,000 and the account totals as 50,000. Again, since nothing is mentioned, it would be the last date of the month, that is 31st March, on which we will find the balance. This balance should be shown as a brought down balance on 1st April. So to balance brought down 2,50,000 in the cash column and 40,000 in the bank column. The third type of cash book that we will do is petty cash book. Now as the name suggests, petty cash book means it is a cash book which is used to record expenses which are of very small amount. Expenses of small amounts and repetitive nature. Now students, understand this thing that in any business there are lots of expenses which occur on day-to-day basis but are very small in nature. Something like stationery expenses, like some small transportation expenses, expenses for replacement of small equipments like bulbs, tubes, etc. Now these amounts, if they were to be recorded by a cashier, then your cash book would become very bulky. That is, cash book would become bulky. And it would increase the workload of the cashier. So to avoid this thing, usually a cashier appoints a junior cashier, which is normally called as petty cashier, for making or meeting the expenses of small amounts which are of repetitive nature. Usually what is done is a small amount is fixed. Let us take an example that in organization X Limited, this amount has been fixed at rupees 500. That means any worker or any employee, if he incurs an expense of amount of up to rupees 500, can go to a petty cashier, submit the details and get the amount reimbursed, or can get that particular item or get cash equivalent to that particular item from the petty cashier. That is, he need not go and trouble the cashier every time. So now what is the benefit? Benefit is that all the transactions are recorded. Mind it, nothing is ignored, but they are recorded with petty cashier, and at the end of the month, all this total, that is the total of all the small amounts, is posted once under the heading of miscellaneous expenses. Now remember, it is not necessary that miscellaneous expenses would be used, but generally it is miscellaneous expenses account. Some businesses might have different names for transferring these small amounts. So now students, how does this system actually work? Now this system works under what we call as impressed system. Now the concept of impressed system. Now students, what is impressed? What is unimpressed? Impressed is something that is something of the nature of fixed allowance that is given to petty cashier. Now, this fixed allowance is called as imprest. Let us take an example. The head cashier gives petty cashier, head cashier to petty cashier, gives an amount of rupees 5,000 for meeting expenses for the month of April 2008. Now students, what will happen is that employees will come for expenses, small expenses to the petty cashier. Petty cashier will make payments out of this amount and keep a record of all these payments. At the end of the month, he will submit the details to the head cashier. All the details would be submitted. Let us take an example again. Let us say payments of 4,500 have been made. So he will have a balance of rupees 500 in hand. After verifying everything, the head cashier will again pay him an amount equivalent to the expenses that have been made. That is, he'll make sure that the petty cashier has a balance of 5,000 for next month. So this is the concept of imprest system. That is, a fixed allowance is made to the petty cashier, who then makes all the expenses out of this amount. Now, a peculiar case. What if this amount is exhausted before the month? That's okay. He'll submit the details before the month is over and get the reimbursement that is required. Now students, understanding how to make a petty cash book. A petty cash book is usually drafted in two different methods. One is simple petty cash book. Simple petty cash book. As the name suggests, it is simple book. It is made on the lines of just like cash book, in which only the receipts and the payments are recorded. Whereas there is another kind of cash book which we refer to as analytical cash book, petty cash book. In this kind of cash book, the amounts are recorded in their respective columns. That is, receipts and payments are recorded. Payments are recorded in respective columns as well as the totals column. So now, what is the benefit of this analytical cash book is that we get the totals as we do in the petty cash book, that is simple. We also get the expenses by columns, that is, all the stationery expenses would be totaled in the stationery column. All the miscellaneous expenses would be totaled in the miscellaneous expenses column. The postage expenses would be totaled in the postage expenses column. So now let us understand how a simple petty cash book is drafted. Now students, the format is just like single column cash book. We have date, particulars, ledger folio and amount column. On the debit side, date, particulars, ledger folio and amounts column on the credit side. So payments are recorded on the credit side and receipts are recorded on the debit side. Date, particulars, ledger folio, amount, and same columns repeated on the credit side. ledger folio and amount. All the amounts that a petty cashier receives are entered here, that is receipts, and all the payments are entered here. So it is just like a simple single column cash book. Coming to analytical petty cash book. Now students, in this kind of cash book, the receipts and the payments that we are making are recorded, but as and when we make the payments, its analysis is also done. You can see the format here. The receipts are here. This total column represents the payments, whereas the columns after the totals represents the analysis, that is the accounts or the various headings for which the payment has been made. It is like postage column, stationery column, conveyance, repairs and miscellaneous. Now students, there is a sort of fluidity in this, that is a particular organization can replace these columns with the kind of expenses that are repetitive in their organizations. Now let us say in a particular organization there is a lot of repetition or replacement of bulbs and tubes. So you can simply replace one column by bulbs and tubes, and you can replace, let's say, repairs. You don't have much amount to put in repairs. So repairs would then be put in miscellaneous, and this column would be replaced by bulbs and tubes. So this kind of adjustment can be made in these columns. So now let us do one question based on analytical petty cash book. Now here are some transactions that are mentioned. The first one being on 1st May received rupees 5,000. That means the petty cashier has received an impressed payment of rupees 5,000 from the head cashier. Since he has received it, so it would be May 1st to cash, and the entry would be made in the receipts column, that is rupees 5,000. Now students, all the remaining transactions here are payments. So now on 5th May, that is May 5, paid postage. So by postage, payment of rupees 100 has been made. So in the totals column, enter rupees 100. And for analysis, in the postage columns, we'll put in 100. That is, the entries would be made in the totals column for sure. For totaling out and finding the balance, every entry has to be put in the totals column. And for analysis purpose, it is put in the respective column. Then on May 7th, purchase stationery. That means buy stationery. Buy stationery 500 rupees. So in the totals column, 500 rupees and 500 rupees in the stationery column. Similarly, on 10th May, paid conveyance. So buy conveyance. 100 rupees have been paid. So in totals column, 100 would be entered for sure. And the second would be made in the analysis column of conveyance, that is rupees 100. And in case conveyance column was not there, then this amount would have been put in the miscellaneous. Coming to May 15th, the month is same, May 15th, paid for minor repairs. So by repairs, rupees 300. This entry would be put in the repairs column as rupees 300 here as well. Recalling the same fact that the entry is made in the totals column and in the sub column for analysis of the same heading if it is there, and if it is not there, then the entry would be put in the miscellaneous column. Now the entry on 23rd of May, purchase stationery again. So now buy stationery 300 rupees in the totals column and 300 rupees here in the stationery column. Now students, there are two entries on the date 23rd here. So now the second entry here is paid postage. Now buy postage, and the amount that we have paid is 200 rupees. So we'll put 200 in the total column, and we have a column for postage as well. So 200 would be put in the column for postages as well. Coming to the last entry, that is on the date 24th, that is May 24th, by charity. Since we are making small payment for charity, it can be classified as a petty expense. So it would be surely put in the totals column, but we do not have any column for charity. So this amount would be put in the miscellaneous expenses column. Now all the postings have been made. Let us find the balance of cash that is resting with the petty cashier. Now students, totaling the sub columns first. Miscellaneous is 100, repairs is 300, conveyance is 100, stationery is 800 and postage is 300. Now we should total the totals column as well. Now this total would come to be 1100, 1200 and for 1600. Remember, the total of the totals column would be same if done horizontally as well as vertically. That is, vertical total and the horizontal total would be 1600. Now students, on the last date, that is 31st May, we will find out the balance. The amount that we had received was 5000. Out of this 5000, expenses have been made for 1600. So the balance would be, balance carried down would be 3400 and the total is 5000 in the totals column and receipts column. Again, we must bring down the balance to balance brought down 3400 on 1st June, whatever is the year. So now students, it is very clear that in an analytical petty cash book, the entries are posted in two columns, the totals column, and for analysis purpose, it is put up in the respective columns if the columns are there, and in case the columns are not there, then the entries are posted to miscellaneous expenses account. Balancing of cash book. Now students, what do we understand by balancing of cash book? By balancing of cash book, we understand to calculate the balance of cash in hand. The balance of cash in hand at the end of a particular accounting period. Now that period can be a week, a month, or a particular accounting or financial year. So balancing of cash book implies to calculate the balance of cash in hand. Let us take an example. Now there is a cash book that has been presented here. It has certain entries on the debit and the credit side. That is, during the year we have received cash on account of these postings. That is, initially we had a balance of 50,000. Then on account of sales we have received cash of 30,000. Ram has paid us 20,000. Vijay has paid us 1 lakh. Similarly, we have made payment for purchases to the account of 30,000 rupees and paid Nikhil rupees 20,000 rupees. Now, how do we find the balance? In this case, we will total out the debit side first. Now, the total on the debit side is rupees 2 lakh. Now students, this total is greater than the credit side. So from this total, the total of the credit side, in this case this total is 50,000 rupees. So deduct 50,000 from rupees 2 lakh, that is the balance amount is 1 lakh 50,000. So this would be what we have balance of cash in hand at the end of this month. So this month ends on 31st January. So we'll write by balance carried down. Now carried down implies that this balance amount would be carried down to next month. So CD implies carried down. So total it out, 2 lakh rupees. Make sure that both the totals are in the same line. Then in the beginning of the next month, that is on 1st Feb, it would be to balance brought down 1 lakh 50,000. So this balance would now be the opening balance for next month. Coming to subsidiary books. Now students, we know what are subsidiary books. These are books which are prepared for additional information. For additional information. They are not required as such. The information that these books provide is usually available in journal and ledger as well. But it is not in a classified form, or it is not, you can say, in a proper format. So you have to extract that information. So these books are prepared to actually show certain additional information. Like for example, cash book. Cash book shows cash and bank balance. Then we have purchase book. It shows credit purchases. Now students, note this point. Purchase book shows credit purchases. Now earlier we used to prepare purchase account. Purchases account shows total purchase, that is both cash and credit included. But if we want to calculate credit purchases, or we want to calculate separately what are cash purchases and what are credit purchases, so then we need to prepare purchase book. Similarly, we have sales book. It shows us the credit sales that are there in the business for a given accounting period. Then we have purchase return and sales returns book. And lastly, we have journal proper, that is used to record entries which are not recorded in any of these books. So now let us recall that cash book is used to record transactions of cash and bank. Purchase book is used to record credit purchase of goods. Now what I mean is credit purchase of goods. Credit purchase of assets is not recorded here. It is only the goods that are recorded, and that also credit purchase. Similarly, we have sales book, which is used to record credit sale of goods. Purchase return and the sales return, as the name suggests, whatever returns we receive are recorded in these books. And lastly, we have is journal proper, that is entries which are not recorded in any of these subsidiary books are recorded in journal proper. Purchases book. Now purchases book is used to record credit purchase of goods. Now students, it is important to understand here that it is the credit purchase of goods. By goods we mean, if we are a trading firm, then the things that we trade in, and if we are a manufacturing firm, then raw materials. And what is important is that these purchases should be on credit basis. If they are on cash basis, cash purchases, then these purchases would be recorded in cash book. They will not be recorded in purchase book. So what is important is that the purchases should be on credit basis for them to be recorded in purchase book. Let us take an example. If you deal in furniture, now any kind of furniture that you purchase tables, chairs, even wood, as wood is a raw material, so they would be classified as purchase. Now if this purchase is on cash basis, then it would be recorded in cash book, and if this purchase is on credit basis, then it would be recorded in this purchase book. Similarly, let's say you deal in stationery. So any kind of stationery items which you purchase in cash would be recorded in the cash book, and if you purchase them on credit, they would be recorded in the purchase book. Now consider an example. In this case, you are a dealer in furniture and you purchase a building. Now building is an asset. It cannot be classified as goods. So that would be recorded in journal proper. It would not be recorded in purchases book. Let us understand the concept or the format of purchase book as well. Purchases book appears like this. Purchases book, date here, voucher number, particulars, ledger folio, details and amount. Now students, you might find some variation in different books also. Sometimes voucher number is not written on the left hand side, it is written on the right hand side. But that is acceptable. These books do not have any proper or well defined format. Sometimes businesses do define or create their own kind of columns for necessary information that they might require. So we will stick to this format, that is date column, voucher number, particulars, ledger folio, details and amount. For that matter, any other book, let's say sales book, will also have the same format, but only the name will change. So now if we have sales book here, then instead of this purchases, just write sales book here and the same format will continue. Similarly for purchase return and sales return. But remember, in sales book only what will be recorded? Credit sale of goods and nothing else. It would be credit sale of goods. So now students, we are clear that in subsidiary books like sales book and purchase book, only the credit transactions are recorded and the formats appear like this. We have date column, voucher number, particulars, ledger folio, details and amount column. Only the name will change at the top, rest the format remains same for every kind of subsidiary book. Let us prepare purchase book from the following information. Now what is important here to note is that it is clearly mentioned that this particular person deals in furniture. So anything that is like furniture or wood or any raw material for furniture would be taken as goods for him. Now the first transaction on date 10th is given as purchase furniture from Messrs. Ram, Agra, 10 tables at a certain price and 5 showcases at a certain price. Now students, both of these items are covered under furniture. So it would be recorded in the purchase book. Look at entry on date number 15th. It is purchased almirah for cash. Although almirah is a part of furniture, but it has been purchased for cash. Now you must recall that in purchase book only those transactions are recorded which are of credit nature. Cash purchases are not recorded. So this particular entry will cross out, it will not be recorded in the purchase book. It will go to cash book. Coming to the last date, that is on 16th of January, purchased from Messrs. Anand and Sons, Delhi, 10 chairs and 5 revolving chairs. So both of these can be taken as part of furniture, so it will be recorded. Now let's see how they will be recorded. On 10th January, mention date here, 10th January 2005, voucher number if it is given to you. In this case no voucher number is given, so leave it blank. Purchase furniture from Messrs. Ram, Agra. So write the name Messrs. Ram, comma, the place, that is Agra. 10 tables at the rate of rupees 1000 each. So the amount totals to 10,000 and 5 showcases at the rate of rupees 5,000 each. It totals to 25,000. Now students, there is a trade discount here. That means Messrs. Ram is allowing us a trade discount of 10%. And it is not mentioned on which of these amounts. So it will be assumed to be on the total amount. So the total purchases are 35,000 less trade discount 10%, 3,500, 10% of 35,000. Deduct it, the amount comes to 31,500. So the recording of the first transaction is complete. This particular purchase from Messrs. Ram, which was a credit purchase, has now been recorded in the purchase book. We had just discussed second entry is purchase of Almirah for cash. Since goods have been purchased but they have been purchased for cash, it would not be recorded in the purchase book. Coming to the entry on 16th of January 2005. Again, there is no voucher number. Purchase from Messrs. Anand and Sons. Messrs. Anand and Sons, Delhi. 10 chairs at the rate of rupees 500 each. The amount comes to 5,000 for chairs. Then 5 revolving chairs at the rate of rupees 1,000 each. Again, the total amount for chairs comes to 5,000. Now there is no discount in this case, so the total amount of 10,000 is transferred to the amounts column, and this posting is also complete. Now, at last, when all the entries have been transferred to or recorded in the purchase book, then total out the amounts column. In this case, it comes to 41,500, and this would be transferred to purchases account. So we will write purchases account debited. Since whenever we purchase, the entry is purchases to creditor. So in this case, purchase account debit. It would be posted to the debit side of purchases account. From the following information, prepare sales book of Messrs. DP Sons, dealers in stationery. Now, here we are required to prepare sales book for Messrs. DP Sons who deal in stationery. So, stationery are considered to be goods for this particular kind of business. So, now let us have a look at the transactions. On 5th April, sold to XYZ Traders Bhopal 100 pencil box at the rate of 15 each for cash. Now students, it is clearly mentioned that these pencil boxes have been sold for cash. Since they have been sold for cash, that means there will be no recording of this particular transaction in the sales book, as in the sales book only the credit transactions are recorded. So this particular transaction would not be recorded. Then coming to 7th of April. In this case, the transaction is sold old computer. Now again, we are selling an old computer. Computer is not a part of stationery. So that means computer is an asset. It is an asset. And this sale again would not be recorded in the sales book, as in sales book only the goods that are sold on credit are recorded. So now students, we have two transactions, one on cash. Cash transactions are not recorded in the subsidiary books, so this will not be recorded. Then in this case, we are selling an asset. It is not a part of our day-to-day transactions. It is not a part of our goods. So this particular transaction would not be recorded. Coming to 8th April. In this case, sold to Messrs. Neeraj Gupta, Delhi, 50 registers, 100 folders at a certain trade discount. Now, this is a transaction on credit, and involves stationery. So this would be recorded. This would be recorded in the sales book. So let us see how we'll record it. On 8th of April 2006, sold to Messrs. Neeraj Gupta. Delhi. 50 registers at the rate of rupees 60 each. 50 into 60 is 3000. 100 folders at the rate of rupees 20 each. 100 into 20 is 2000. Now students, there is a trade discount also to the extent of 10%. So this 10% would be charged on the total of the sales to Mr. Neeraj Gupta. In this case, the total sales are 5000 less 10% trade discount. 10% of 5000 would be 500. Bracket here indicates a deduction. So 5000 minus 500 would be 4500. Now, so total sales to Mr. Neeraj Gupta amount to rupees 4500. Now, in this case, there is no other transaction that will be recorded in the sales book. So let us total out the sales book. The total would be 4500. Now, sales account, that is any sales that we incur are credited. So this amount would be posted to sales account on the credit side. So we'll write sales account credit. Record the following transactions in the sales return and the purchase return book of Mrs. Gyan Prasad. Now here we have to record sales return and purchase return. Now remember students, sales return is sometimes also referred to as returns inward and purchase return is sometimes also referred to as returns outward. So now students, let us try and record these transactions in return inwards, that is the sales return book, and purchase return, that is the returns outward book. Now students, on 3rd of January, the transaction is returned to Anand. That means we have returned to Anand. That clearly means that we must have purchased it earlier from Anand. So it is a purchase return. So in purchase return book on 3rd January 2005, no voucher number is there, so leave it blank. Return to Anand. Just write the name of Anand. 5 tables at the rate of rupees 2000 each. So the total amount is 10,000. So the total purchase return that is recorded in this transaction is 10,000. Coming to the second one, Neeraj returned goods. Now Neeraj returned goods. That means Neeraj is sending us back the goods that we had sold him earlier. So that means earlier we had effected a sales to Neeraj. Now Neeraj is returning that particular amount of goods to us because of any reason. Now the total list price of the goods that he is returning is 2500. So this will be recorded in the sales return book. The date is 5th of January 2005. Neeraj, since nothing is specified, just mention the amount here 2500. And this recording is complete. For your sake, you can mention goods. Now, coming to entry on 16th of January. Anurag returned 10 chairs. That means we had sold certain chairs to Anurag earlier and he is now returning those chairs to us. So since he is returning it to us, it is sales return. On 16th of January 2005, we'll write Anurag 10 chairs at the rate of rupees 500 each So the total amount for 10 shares comes to rupees 5,000. Coming to the entry on 27th of January. Now students, it is returned to Vijay one cupboard of rupees 5,000. Now we are returning to Vijay. That means we had purchased it earlier from Vijay. So it is a purchase return. So should be recorded in the purchase return book. So in purchase return book, it would be Vijay one cupboard, amount is rupees 5,000. Now all the entries have been recorded here. Let us total out and transfer the balances to their respective ledger accounts. In case of purchase return book, the total comes to 15,000. Now students, purchase return has a credit balance. So purchase return credited. That is, it would be posted from this side to the credit side of purchase return account. Coming to sales return book, the total comes to 7,500. Now sales return has debit balance. So sales return on the debit side. So now students, remember that in case of questions like this, you have to identify the transactions, which one to be put in sales return or purchase return, and for that matter you can have mixed entries for purchase and sales book also. Do keep in mind, sales return is also referred to as return inwards and purchase return is also referred to as return outwards. Journal proper. Now journal proper is a book which is used to record entries which are not recorded in any of the subsidiary books like purchase book, sales book or cash book. So journal proper is used to record transactions not recorded in any other special book like cash book, sales book, purchase book. Now what are those transactions? These transactions can be like opening entries. We all know what are opening entries. These are entries which are used to record the opening balances of assets and liabilities in the beginning of an accounting period. So such entries are always recorded in journal proper. Then we have any kind of rectification entries. That is, entries which are used to rectify errors which have been detected in any of the previous books or any of the previous postings or recordings. Such kind of entries are always posted in or recorded in journal proper. Let's say the total of the purchase book is wrong. So now purchase book will not be used to rectify that error. That error would be rectified through a rectification entry in the journal proper. Then we have transfer. Entries relating to transfer of balances. To transfer of balances. Now students, we all know that nominal accounts are transferred to profit and loss account at the end of the accounting period. Let's say sales and purchase. These accounts are transferred to profit and loss account or trading account for the purpose of calculation of profits. So the entries for transfer of these balances are passed in journal proper. Then there are other entries. Other entries like loss by fire, theft, entries relating to charity, prepaid and outstanding expenses, drawings, of goods. Such kind of entries, there can be many more also. So such kind of entries are always recorded in journal proper. There is no other book to record these transactions. So let us repeat. Journal proper is a book in which transactions which are not recorded in any other special book are recorded. Any other special book means either the purchase book or the sales book or purchase return, sales return or cash book. So such transactions are recorded in journal proper. Some examples of such kind of entries are opening entries, that is entries in the beginning of the period, rectification entries, that is entries used to rectify errors in any of the special books, then entries relating to transfer of balances like nominal accounts which are transferred to profit and loss account at the end of the period are passed through journal proper. Then entries relating to loss by fire, theft, entries relating to charity, then prepaid or outstanding expenses and drawings of goods. Mind it, there can be many more entries like these which are recorded in journal proper. Balancing of accounts. Now students, we all know that once journal entries have been passed, they are then posted to ledger accounts, that is on the debit side and on the credit side. So by balancing we means to find the balances at the end of accounting period, that is whatever period that you have defined. It can be a week, it can be a month, but we all know that legally in India it is accepted to be 1 year. So by balancing we means to find the balance at the end of an accounting period. Now students, how do we find the balance? The first step is to total debit and credit sides, and they are in rough. They are not written in the accounts. Find the total of the debit and the credit side. Then find the difference in debit and credit sides. That is, let's say if debit side has a total of 2 lakh and credit side has a total of 1,50,000. So the difference is subtracting them 50,000. Either ways, you can have debit can have a total of, let's say, 3,50,000 and credit has a total of 5 lakh. So the difference would be 1,50,000. Obviously, we are not taking into account their positive and negative signs. So by difference we mean to find the difference in the totals of the debit and the credit side. Now students, once we have found out the differences, then try and analyze whether the debit side is greater than the credit side. If the debit side is greater than the credit side, then balance is written on credit side. That is the smaller of the two sides. Then if debit side is smaller than the credit side, then balance is written on debit side. Again the same concept applies here, that whatever the difference, if the debit side is smaller, then it is written on the debit side, and if the credit side is smaller, then it is written on the credit side. That is the smaller of the two sides, and then you can total out the accounts. Now let us take an example and see how it actually works out. I am drawing a T-shape account here, let's say for cash only. To Ram 50,000, to sales 1 lakh, to Neeraj 20,000, and on the credit side we have by purchases 30,000, by wages 15,000. Now students, it is a T-shaped account. Let us find the balance. This is credit side, this is debit side. Again, following the same steps, on the debit side, the total is, this is rough work, the total comes to 1,70,000. And on the credit side, the total comes to 45,000. Now students, the debit side is greater. The debit side is greater. And the difference in the amounts is 1,25,000. Since the debit side is greater and the credit side is smaller, we all know the balance is substituted or is actually shown on the smaller side. So in this side, the balance would be shown on the credit side and written as by balance CD. CD means carried down, that is carried down to the next accounting period. So in this case, 1,25,000 will appear here and the totals would be 1,70,000 on both the sides. Now, this balance of 1,25,000 that we have calculated will be shown on the debit side as to balance brought down 1,25,000 in the beginning of the next period. This brought down means that this balance has been brought down from the previous accounting period.